Good evening, everybody. My name is Daniel Young. I'm the owner and founder of Adaptive Perspective and the Adaptive Perspective social media platforms, and I am back to talk about our stock market strategy using closed-end funds. So to get the normal disclaimers out of the way, this is an unedited video. Who knows what you'll hear in the background as I film these in my house. And tonight's a busy night. It's preparation for a school week or an almost school week. You've got both of us doing what we need to prepare for work tomorrow. I'm making a video while my girls work in the background. So if you hear the door open or the alarm go off or anything's possible, who knows? The cat might even make another appearance. All right. So I am not a financial advisor. I am a financial strategist and a strategist. And I don't speak like the herd. I walk in limited company and sometimes I walk alone. So I am working on the Substack update. It's been, quite honestly, it's been a slow go with me back at campus and I feel like Bugs Bunny when he's all stretched out going eight different directions. It's, there's a lot going on, and I'm just not making a lot of progress in everything. I feel pulled in a lot of different directions right now. So I'm hoping that, in a sense, calms down. And even if I take away the back half of that, I can still get pulled in four directions going forward, but I can still make some forward progress. Um, I'll say this at the end, but I say it here as well. It help me hack YouTube and help me help more people. There is a better way to invest than individual funds with shitty yields and the hope of growth. Because that's really what you're hoping on. Like buy Apple and hope it gains 10% over the next 5 years. That's 2% growth. I mean, even if you believe the Fed, which I don't, but even if you believe the Fed hits 0 to 1% inflation or below 2% inflation, what they're hoping for, uh, if it's at 2% inflation, and which I don't think it is, I always think it's more. But if you take the Fed's word and it is 2% inflation, your 2% average growth is break even. So a year from now, you're just behind. And 10 years from now, you're even further behind. Or 5 years from now, you're even further behind. So there's a better way than single stock investments. There's a better way than the 60-40 traditional stocks to bonds bifurcation of your portfolio. There's a better way than the I think it's 1.3 annual yield average out of the S&P 500. All of that traditional advice helps your broker make you broker. Your broker gets paid, you might get paid. And you can do it on your own, quite honestly. I mean, yes, you can go broke on your own, but you can take on the risk and the reward of managing your money yourself, not paying anybody else to do it. So you're saving money there, and there's a better way to invest than that traditional stock market advice. Invest in closed-end funds, cheaper buy-in, less risk, greater dividend, and you still play the market as it's laid, except instead of playing the market buying for today with today in mind, we're buying today with the future in mind. You're scooping deals in the present market and using those towards a long-term strategy. We're building a no withdrawal portfolio to where you can buy and sell inside the portfolio, but you're not liquidating that portfolio when you die or when you retire or whenever, right? The 4% rule is you're selling off your portfolio. And even that 4% is a bad strategy to begin with. I mean, think about it, 4% of a million is 40 grand. Are you living off of more than 40 grand right now? And if you are, then you're automatically set up to fail at the 4% rule because you're going to take out more than 4% every year. Versus the closed-end fund portfolio pays, I think, 8.5% is the current average annual yield across the closed-end fund market space. So you get a cheaper buy-in, you get better rewards, you get better dividends. And if you can ensure that your principal stays intact, or as ensure as it can in the waving up and down of the market, your dividends remain consistent, or ideally they go up, right? And if you have to sell something, you're selling it for something better. Like everything comes in waves. There's the bond timeline and the oil timeline and the energy timeline and the US stock timeline. You're playing all of the current deals for a long-term game. So if it cycles out and it's time to sell, that's fine. You're selling and you're rolling the money forward into a better investment for you. So we're creating a closed-end fund. I'd love to say focused, because it is all closed-end funds, but we're creating a closed-end fund portfolio that's no withdrawn, crushing on dividends, right? So we get consistent payments regardless of what the market does. That's much better than traditional stock advice. So if you like the message, if you like what you hear, then share it. Don't just keep it to yourself. Help me push and get the message out to more people. So like the videos, subscribe to my channel, comment on the videos, and feel free to comment about whatever. You can ask what I'm buying, which I'm pretty open about what we're buying. You can tell me what you're buying, or you can pick my brain on any number of things. So yeah, thank you in advance. So thank you, and thank you in advance. Um, if we look at market strategy week to week, so if you're new, normally I break down the market week to week, month to month, and give you my take on what's happened and what I think will happen. And I can do the same thing I did last week. I can read what I read last week word for word, which, and I I make myself notes. I have a script and an outline, but it's not word for word. So I can tell you the same stuff with a slightly different twist. But the market honestly is much the same. Not much has changed week to week. We had a slight tariff dip, but it responded faster than I thought it would. Um, my goal was I lost track of time on Monday at meetings, and I thought the market would at least lull through Tuesday or Wednesday. But with positive things coming out, like big announcements coming out, it didn't dip that long. Didn't even dip that far. I was honestly surprised at the sheet. Um, but it kind of it leaves us in a lull, and it doesn't. It feels like a funk, to be honest, because the Fed should be cutting rates, and the Fed, we've discussed, the Fed's not going to cut rates because they lose power. So the Fed should be reactionary. It's set up to be reactionary. Here's the data. This is our response. And what it's become is we like controlling the narrative. Currently, the Fed reads the data and tells you what you should be afraid about. Like they're afraid of tariffs. Well, okay, research has shown tariffs don't have an impact on inflation. So here's the data. Oh, but we don't want to change rates because tariffs are scary and might impact inflation. But they don't. But we're not going to cut rates. Or inflation is up. We've printed $4 trillion, but we can't tell you why inflation's gone up. And that just doesn't make sense. So the Fed is supposed to be reactionary. Here's the data. Here's our response. Let's see what happens. And then you get new data. But the Fed has become, we like control. We like setting the narrative. We don't want to be reactionary. And in that mind shift on the Fed's end, they've actually proven my point all along. We don't need the Fed. The Federal Reserve prints money and contracts money based on data, supposedly. But for the last 7 months, they haven't done their job. They cut rates going into an election year to make the incumbent party look amazing in a crappy economy. So they cut rates when rates should have stayed the same. And since then, when inflation is down and prices are down and things are getting better, more money's pouring into the economy. All things that point to we should have lower rates. The Fed has decided that we don't need lower rates because they're scared of things now. Bullshit. All that says is the Fed likes control. So they've also proven themselves unreliable, not well, unreliable, not trustworthy kind of go together, but they are rendering themselves obsolete. If the economy continues to chug along, regardless of the Fed's power grab, we don't need them. Well, then what happens to interest rates? What happens to this? Well, it's all if you take the Fed away. So the Fed came into existence to tell you how things are. because we got rid of a gold standard, meaning so much gold, like an ounce of gold equals so much paper money. So $1,000 equals an ounce of gold. Then you work back from that and you can tell what everything actually means. So where the paper money is printed the same, but it takes more paper money to buy an ounce of gold. So if inflation goes up, money is devalued and now gold costs more. If we went back to that system, we don't need the Fed. And we also don't need the IRS. So, well, why not go back? I don't care what standard, gold standard, silver, copper, brass, like anything to have a standard, a fixed standard of what the value of a dollar bill should be, because currently the intrinsic value of a dollar bill is only as it's only worth as much as people think it's worth. Meaning, if a dozen eggs are worth $5, and then eggs go in short supply, and now there's not as many eggs to go around, suddenly they're worth $7 a dozen, which is obscene and crazy, right? But that's what it turned into. It takes more money to buy the stuff. We would still see inflation, but we wouldn't have the Fed. And that's honestly, like, the interest rate issue would go away. The IRS stealing our money and repatriating it as other things on the back end would go away. And so, getting back, otherwise, rabbit holing is a dangerous, slippery slope for me. So, if we focus on the market, not much has changed. The Fed is still a corrupt board of people who should remove Jay Powell from service, but they're not. And why hasn't President Trump appointed somebody different? Well, either he doesn't think he has the votes, or he can't find the right person. And I would bet a combination of the two, because when you're looking at, when you're looking at a corrupt system, and especially that corrupt, especially the 13 board governors of the Fed, you can sound like you can speak your mind. And, like, I want to say two people have spoken out and said, yeah, we could see rate cuts sooner than later. And Jay Powell's come back and said, nope, not going to happen. Um, Something smells rotten. Like, only 2 of 13 have broken ranks. That doesn't say a lot. Um, something, uh, there's definitely a lot more than meets the eye. And it can't be just an easy swap out. I mean, it can, right? 13 people, one person deciding. But if you want to keep your power and consolidate your power, those others can replace you just as easy. So that doesn't, I don't know, something stinks in the land of Denmark, but we'll see what changes with that. Otherwise, outside the Fed being a power hungry, money grabbing, dastardly group of people, I mean, there's more money pouring into the market. And that's honestly about it. I would read you the same stuff from last week, but I don't like repetition and I don't like wasting your time. So, what's our focus? What makes the most sense in this prolonged time between economic cycles? Like, where are we? I still think we're riding. I still think we're riding up the next wave. It just hasn't crested yet, mostly because the Fed won't cut rates. If the Fed cut rates by 1/4%, the economy would break open. It would juice the economy, right? And then they would continue to cut rates, and you would see our economy across the board, every income gap, every income category, just take off. But they haven't done it. So, what makes the most sense? You got the hope of coming rate cuts, but currently haven't happened yet. So, I still say bonds and bonds proxies. So, like outright bonds, corporate bonds, but then you get real estate, BDC, business development companies, utilities, energy transfer, CLOs, collateralized loan obligations. Um, Oil fits into that. If you can find cheap oil right now, that's amazing. Or if you can find discounted oil, that's really the kicker. Cheap oil is relative, but discounted oil is a little bit different. Um, if you can find discounted tech, that's a great deal. If and that plays into stocks overall, it's very much a bonds and bonds proxy market in the sense that bonds and rates work inversely. So with high rates and low bond prices, that should flip. If we get lower rates, bond prices ought to go up. Dividends should stay steady or go up. And US stocks, everything should do better in a rate cut. And with all the money pouring into the United States by company and by, I won't say country, but by company pouring money into the US stock, their value and their abilities should go up. So it's a great time for both. If you had to pick, I think I could justifiably argue for either. The what makes the most sense are bonds and bonds proxies, just based on rates. If we look at the hope of future growth, that's it's all risky. But I think you could flip a coin and even stand that coin on end of what you pick. So yeah, let's check out the week and let's at least check out the list for the week, and then we'll go from there. And it's since I updated the list, it's quite a lengthier list. So this week, there we go. This week. So it's a general system update for the week. It's not the giant update, complete list update like I do every month. So everything, so green, purple, these demarcations, the blue colors, all of that got updated this week. And what was significant out of the bunch is on this list. And let's see, that's my cat in the background. Um, let's see where to start. So they're all significant targets. Well, they, yeah, that's my cat. He's feeling the loss of us not being at home anymore. So he's been needier and clingier. Also much more outspoken. He's torn between wanting to sit in somebody's lap. He wants to play or he wants food. Um, let's see. So if we look at the targets, triple asterisk is a significant discount specific to that one company. Um, these at the bottom in doubles are dollar cost. Their dollar cost average buys in the sense of their current price is lower than our average price in our portfolio. ASG just got added. It's 2 cents less. We just bought. We're not buying tomorrow. Um, but of the dollar cost average bunch, the discount for these has dropped considerably. Um, overall, if the if things move into premium territory, honestly, we want that. We want them to be, oh goody. Uh, we want things to be more desirable. Uh, we want to buy and discount, but at the same time, a lot of people buy when it's more desirable. Um, just interesting strategies. So for my purposes, we're going to take off the two asterisks. We just bought, we're not going to buy again. But none of them fit our parameters. Yeah, ZTRs on my sell list. The municipal bonds are great for safe in the sense that the default rates are incredibly low, but the discount windows have closed considerably, and they're not as appealing as they were when they were at say 5 to 10% off. So let's look at payment policy. I like monthly payers unless you can justify something else. And USA, you can justify it. But it doesn't exactly meet the discount right now, which I thought I screened these, but I guess I didn't screen them that well. Historical discount, honestly, we want the current discount around 6, because that would be about double. It's close. We'll leave it. You can justify it how you want. I am not an Aberdeen fan. Uh, I think DX it's an index fund that's great for low volatility because it does really well in higher volatility. DNP is monthly, so Aberdeen. Yeah, I'm not a huge healthcare guy, but those three don't really fit the bill. USA, there are four there are four prime blue chip US stock funds that I've found. NBXG, which plays to tech and 5G. ADX, which has a super long track record. Uh, similar commitment to USA. Their goal is to pay out at least 8% of their NAV in dividends. I guess in this case quarterly. Um, and ASG and USA are sister funds, and they are structured differently. So bought together, they give you a really great, uh, like a really great, I don't know, couple portfolio into the blue chip sector of the market. Um, let's see what else I wanted to say. The of those four, only NBXG pays monthly, and I'm a monthly guy, so I'll buy quarterly stuff when I need to, or when I need to, or when I can't find it in a monthly. But it's not my favorite thing because it's not a monthly payer. Um, all right, so outside of justifying what stays on the dividend policy breakout, then we look at yield, and I like 9% or better unless you can justify picking up something that has a cheaper dividend. HFRO is one of those. It's consistently the largest discount, and that discount has closed recently. It went on a tear last week. Um, I think there's more fear than there should be surrounding that portfolio. That's me. They have a ton of square foot, a lot of it being built. As more of that square footage comes online, their value should go up. DNP they pay a consistent dividend, which is great, but at the same time, it never goes up. But as the market ebbs and flows, so as their price goes up and then goes down, when it dips down, it's a great buy. It's a great bond proxy buy. There we go. Um, and the strategy is, I mean, depending on how you want to go, depending on how you want to swing it. If you want to buy it low, sell it high, or if you want to ride it high, so when it drops back low, you can buy more of it. Um, but when the discount hits around or exceeds the 52-week average, then it's a great time to buy. And 4.5 is close to 5.2. ERH, I'm not a huge fan of. All right, so municipal bonds here. So we're looking at 9 or better. So we're kind of trimming as we go. RMM, we already own 3 municipal bonds. I'm not interested in picking up another. These two. I'm not an Allspring fan. We owned an Allspring fund that it was not, from my perspective, it was not managed well. Just not a huge Allspring fan. Additionally, their dividend fluctuates madly. Like it's in the sense of it's different every month. And for somebody who likes consistency, that's not a great thing. The other fund I took off is another municipal fund, but at the same time, it's not completely tax free. Like there's other stuff in the portfolio, and if you're looking for an outright municipal bond play that does straight tax equivalent yield, that's got other stuff in it. NBXG has paid a consistent dividend. Their price has gone up considerably. They have not raised the dividend. Um, it pays under 9%, but it's still worth a look. Um, when I want to maybe 3 weeks ago, I really deep dove Eaton Vance, Calamos, and ADX, and really looked at their portfolios and really tried to be objective as possible in filtering out different funds. Calamos has been on my hit list a while, so has Eaton Vance for that matter. But when I look at their portfolio and how they're invested and where they're invested, I'm a guy that understands diversification, but at the same sense, I don't like overly diversified things simply for the fact of being diversified. Like butter scraped over too much bread. Or say if you took that piece of bread and you scraped butter over the top and you ended up with not enough butter for the whole thing because you're investing in everything. If you imagine the butter as money, which I know is a weird analogy, metaphor, but if you imagine that scraped over butter as money and you're expecting it to grow, it's really hard for it to grow because it's so spread out. And when I look at the Calamos and the Eaton Vance portfolio, they're similar in size, similar of money of investable funds compared to ADX, but at the same time, ADX is invested into less than 100 companies. And you've got Calamos and Eaton Vance invested into like 500 and 600 companies. So that's great in the sense of the risk is spread out, although there are heavy allocations at the top of their portfolio. But ADX has a very focused portfolio, and they are heavily invested into tech because we're at that upward escalator, upward wave of the next technological revolution. So that makes sense. So I picked ADX over Calamos and Eaton Vance. And yes, they have significant discounts. And yes, they pay decent dividends. And yes, their price has gone up, like everybody's price has gone up. But knowing that deep dive and the sense that the ADX, USA, ASG, and NBXG portfolios are all crafted with the same outlook on diversity or on diversification, like they're targetedly invested in this specific niche versus Calamos and Eaton Vance are kind of like all over the place. I'd much rather invest into, yes, this is our strategy, than, yeah, we kind of invest in everything. So I get that they're attractive, but when it comes to buying, you can't invest in everything. TEEF finds itself in an interesting place. I think there is a place for solar. I think there is a place for wind energy. I think there is a place for water. Hydroelectric is amazing. I think there's a great place for it, and it's often in rural areas. The wind farm it only succeeds on government subsidy. I mean, it takes a diesel motor and oil to turn the blades fast enough for the wind to propel it. So that's not green tech, that's not green energy. Now the wind can push it faster, but it still takes oil in order to maintain it. And that slow moving cycle on a non-windy day, yeah, that's all a diesel motor. When the product breaks, it has to go to a specific landfill. They're not getting remade into other stuff. You're digging a hole and burying this giant metal blade. That doesn't sound like green energy. Solar needs oil in order to work. Hydroelectric needs oil in order to work. So I think there's a place for it. Like if I'm in the middle of nowhere, Oklahoma, with no service, I mean, Starlink is my friend because there's no way cable or anything else is coming out there. Then that's a great opportunity for solar, or if you've got a stream that flows through your property, that's a great opportunity for hydroelectric. But crafting an entire portfolio on the premise that oil is bad and all of these other energies which rely on oil, all of these other energies are the solution to no oil, which doesn't make any sense, finds itself in a position where China, 90% of all solar panels are made in China, and now there's an added tariff on Chinese products. Plus, you have the Trump administration taking out the subsidies for clean energy because it's really not doing better in competing with oil. It can't. You have to have oil in order to have the product. You have to have it in order to have it and make it and maintain it and install it. So it's not as good as what it says. So you've got President Trump's administration taking out the subsidies for wind farms. And then, yeah, solar panels have a new tariff coming in and just doesn't seem like the best investment. Doesn't sound like the best portfolio to me. People love the idea of it, but I mean, me personally, I don't like the idea of it. Um, it's also interestingly a term fund. 6 years from now, it goes away. Um, and quite honestly, if it survives the next 4 years. Uh, let's see, RLTY, Conan Steers runs three different real estate funds. This one, RLTY is interesting, but it's over $15 a share. But it it's not real estate in the sense of HFRO portfolio, which is like physical property, single family home. This is all like business and data and tech, and it's an interesting take on real estate. It's cool. It's just uh, I honestly need to look at RLTY's portfolio versus RFI's portfolio. RFI is another Conan Steers fund that we own that habitually runs in premium. So it generally doesn't make this list. But, and even though it's $15 a share, if it offers a different portfolio than what we already have, that could be an interesting pickup for us. DLY is the sister fund to DSL. It's a bond fund. It's a recognizable brand name bond fund, but we already have several. I don't really need another one. CIF, um, we bought on a roller coaster strategy in the sense of when rates drop, yes, it should go up, and it was selling for cheap, so we bought a decent, maybe 500 shares of it, with the goal to just hold on to it and wait for it to ramp back up because it does follow the rate pattern. But I wouldn't buy more of it than what we already have unless it dropped low, and uh, I'm not going to add it to our individual fund. FTHY, yeah, FTHY, I don't know enough about besides it being a bond fund or what seems like a bond fund. Fins is an interesting play on the bank end of things, but we've already done similar through something we already own, and I honestly can't remember which it is. RA is real estate that typically doesn't dip down, to be honest. Um, that was on our list last week. USA makes the list. So let's see. HFRO stays because of the discount. Realty would stay not so much because of the discount, although it doesn't dip into discount this deep generally. It's not that old, but it's really what's in their portfolio. So when you think of data and where we're going with 5G and technology, that's a lot of their portfolio. All right, so bonds we've got, bonds we've got. I don't know enough about that portfolio. Banks and bonds we already have. Real estate, I would have to deep dive and see. So I can at least leave it on the list for right now. USA stays as far as it's close. Um, it met the metric when we bought it, but it doesn't quite meet the metric now. Um, but you can make a good case for it. PDO is generally above my price point, or maybe not. Maybe no, I'm confusing PIMCO funds. So same idea as ADX um, and DNP. It's we want an average that hovers around or exceeds the 52-week average. So at 441, that's around the average, but at the same time, we already own a lot of bond funds. So picking up a brand name bond fund is great if you want more just brand recognition in the sense that PIMCO funds generally sell for a premium, hence why it's an exception to the asterisk rule. But at the same time, we're already well invested in a bond, so adding another one just feels like too much icing on the cake. New Veen multi is 50-50 stocks to bonds, fits our metric, but um, I mean, it's not going to make my list. BRW is bonds and a lot of other things, precious metals, crypto. Um, their discount has changed considerably. It's about 80 cents up of where we bought it at the lowest it's been. Uh, Discount generally doesn't hit this low, right? Generally. HGLB was on the consideration list for last week's, or I guess the buy-in we did at the beginning of the week. I'm I'm hesitant because there's a midwave wireless company that's maybe like between a 25 and 30% allocation of their portfolio. That's interesting. Um, then they've also got some other companies inside there. I want to say they've got, I looked at a lot of funds this week. So if I get this wrong, I apologize. I want to say they've got a decent allocation for Victoria's Secret, which is not a bad thing. But in that market space, you've got more shops of that nature moving online unless they just have a stellar physical property business model. Um, and you've got other stores facing closures. So mean, I honestly don't know how Macy's stays in business. Saks Fifth, God, Saks Fifth Avenue shifted to an Amazon platform. So instead of going to a mall to pay $10,000 for a couch, because everybody goes to a mall to drop 10 grand on a couch, they closed their mall stores and they moved to Amazon. So now you can buy a $10,000 couch on Amazon because that's why people go to Amazon too. But it's that brand recognition. I mean, people love Saks Fifth Avenue for whatever they're selling you, and you're going to pay that top dollar price. And they went to an online model. Fredericks of Hollywood has gone to an online model for a while. So it just kind of wondering how long it's going to take Victoria's Secret and others to move to the same thing. Uh, the CLO debate. So last week on this style video, I debated CLOs and told you I left a lot on the list and told you that I would really have to dig into everything before I really made a choice. And I dug into everything and I went with what we already own, OXLC. Part of that is you can find this article with this hyperlink. You might be able to search it in Google because Seeking Alpha does a lot of free articles now, but that URL will take you straight to the article and it lists out OXLC's history and why the guy who wrote the article, which I forget, considers OXLC still a good buy, which I would agree with him. And he does a really great job detailing out history and CLOs and everything else. But outside of that article, comparing companies just based on the data on CF Connect, and then looking a little bit more further around, a lot of these companies are brand new. And CLO funds are a very specific type of investment. to the point where most people who see them will have no idea what they're really investing in. And you can search the terms, tranches, look, collateralized loan obligation. It's kind of related to the bond market, and there's credit risk and credit scare and default rates. And currently, that market is seeing a scare related to defaults. And I don't see the scare, but you're dealing with the herd, and the herd really gets turned wherever the handlers really want to steer them. So in the CLO market space, because it is such a niche community, you want someone with experience and skill and finesse in handling that specific niche community. And OXLC has the track record. A lot of these other funds are brand new. Earn, which didn't make this list, I think I took it off the track list. But Earn, maybe it's still on the track list. But at any rate, it didn't make this list. Earn is like 4 months old. And yes, as a company, they have a history of dealing with CLOs and mortgage-backed securities and loan, all that stuff, right? They've got a history with it. But I didn't find a single company that had OXLC's history of managing CLOs and of effectively managing a CLO fund. So I get that they pay great dividends. It CLOs in and of themselves, it's a niche marketplace. Like in the broader market, you're looking at a corner of the market with closed-end funds. And then inside the closed-end fund market space, you're looking at an even smaller corner of closed-end funds dealing with CLOs. You want somebody that has the knowledge, skill, wisdom, track record, ability, keep listing your terms to navigate the waters of the CLO tranches, but also the closed-end fund market space. And it's great that like Eagle Point it seems like they have a great track record of managing funds. Carlisle says they have a great track record and expertise in managing funds. Same with OFS. But yeah, unhappy cat, hungry cat. Um, but on my end of things, this company has the longest measurable track record on CEF Connect. Let's see. Saba stays. Life happening in the background. Aberdeen, I'm not a huge Aberdeen fan. Hicks always looks great, but it doesn't outperform its competitors, and I'm not a BlackRock fan. I don't mind that BRW is invested in BlackRock because they're pushing BlackRock to change their shareholder responsibilities in the sense that they're trying to get BlackRock to pay a better, more competitive dividend instead of keeping that money for BlackRock. So I like that BRW is an activist fund in the sense that they're fighting for shareholders, but I don't want to buy BlackRock outright. So that leaves me with this: CLOs, BRW, or so CLOs, bonds, and other stuff. Bonds, crypto, closed-end funds, metals, minerals, and that shareholder activist mindset. USA, that yes, it's the dividend reinvestment plan, but it's not mandatory. But it's a heavy hitter US blue chips. There we go. RA, which is all real estate. Realty, which is real estate. NBXG, which is all US stocks, particularly 5G stocks or stocks that would benefit the most by 5G technology, which you could argue all of them. Every company would benefit with more tech in a sense of becoming better streamlined, better functioning, but some would benefit more. DNP is utilities, and then HFRO is real estate. And that's the list for the week. Now, we already bought. We bought this list at some point 5 days ago, whatever 5 days ago was. And I have this video, but I have not posted the portfolio update for August yet, but I will. I will also post the portfolio update for June. And then my goal is to make an update on how I update the portfolio, which comes at a great time because with the idea and this self-push, but also just I feel like I need to move my these videos will stay. I have no plans of changing these videos, but my financial strategy system, our financial strategy system, I need a better place to house that product, that system, and share it. And creating a closed-end fund, um, I don't want to say tag along, but like a subset. So my goal is to move it to Substack. If I can, with the have a Substack on the 12 steps to financial freedom, and under that, list the closed-end fund space, and quite honestly, charge a membership for the data. But inside that market space would be this entire spreadsheet. So you'd have all my notes, you'd have past video information, you'd have what we bought, you would have access to the portfolio to where you could see it and download it. But this presents a great opportunity for me to teach people how to update the portfolio in a sense that I have not added USA or ASG yet because I bought them. And then what I explained on the video that was like, I thought I had the ex dividend dates correct, but I did not. So that the question is, do we hold them for 4 months before we get a dividend, or do we sell them at some point before the dividend gets paid? Um, and I don't know. We'll see how that goes. But in adding them to the portfolio, I haven't added those yet. But it would be how I add funds to the portfolio, and then how I add funds to this portfolio, which that's pink because I need to update it. Um, but how I add funds to this between what I anticipate will happen and what does happen, and then how I get this spreadsheet to communicate with this spreadsheet and how they work together. Because this dividend data, I track each buy we make and the dividends for that specific buy and the price related to that specific buy of when we bought in versus what it is now. And these portfolios work, or these spreadsheets work together. So, I mean, waiting to add the funds just presents me an opportunity to show how that works together. Um, that would be this list. And I passed on ADX because we had missed the dividend date, the ex dividend date, in July, and I didn't want to hold it, and not get a dividend. We'll get a dividend in August. I didn't want to wait another 4 months to get the next dividend. Versus their next ex dividend date is, I want to say, mid-November. So if we bought it again, we would buy it maybe late, I don't know, late October, early November, pending on the discount. That's the other factor. Um, you don't want to miss the discount. So if you're using the discount as your overall justification of buying a fund, you want to buy the stuff when it's at discount. And that's kind of the issue with these two in general. USA makes the list this week, kind of. You could justify it and then it's close to where it was. ASG doesn't make the list, right? USA is, I mean, the existing discount of today should be at least 6% in order for it to really be on the list. And it's not really at that level. So it doesn't really belong on the list. So we bought the opportunity. Maybe that would happen before we bought them again. Maybe, maybe not. So your hands are kind of tied on when you buy stuff if you follow the discount as your sole justifying metric. Like the yields we can talk about, right? Monthly or dividend policy we can discuss. I love a monthly payer. Sometimes you have to pick up a quarterly if you're really going to pursue that strategy option. But if you're going by discount, then sometimes you just can't buy stuff. Now you can. It's your list. It's your portfolio. It's your strategy. Do whatever you want, right? Play the game however you want. But if you're sold on using the strategy for that purpose and then you start changing it, like, oh, I'll change it this month, then I'll change it next, it makes it, I don't want to say it's a bad thing. Like you're holding yourself accountable. And I get it. Stuff happens and you make a mistake, or stuff happens and you choose. Like, I'm not trying to tell you if you're right or wrong. Just trying to tell you how I feel about it. If I'm gung ho, guns blazing on that one thing is my sole justification for buying funds, and then I break it, then it's not really a standard anymore. So just throwing that out there. But since I haven't added these to the portfolio, it gives me a great opportunity to make a video on how I add stuff and the formulas and how it all works together. So that's all I got for the week. And let's see. So if you have questions, by all means ask. If you like the content, please share it. Please like the videos. Please subscribe. Please help me push the message out that there's a better way to invest in single funds. And on the Substack, I will keep you posted. I've got to build some stuff out overall. I've got to build the 12 steps to finance, or well, build the 12 steps to financial freedom out, meaning besides just making the page, I really need to craft and mold that. Yeah, craft and mold it to where I can build it out for a while in front of me. Um, there is a scholarship piece for college and of any age, college, grad school, post grad. Like there's a scholarship piece to this, and then there's this piece to this, and then there's just us walking through the system. So I've got a lot to do on my end. But if you're interested in all that, uh, I don't think I've added the Substack to the description for my YouTube channel yet, simply because the Substack is not like it's there, but it's not really built out. Uh, but it's got the same adaptive perspective handle. So you can check that out if you want, but you're not going to find much when you go there. Um, I'll keep you posted on these videos. But yeah, whatever you have for the week, I hope it goes well. Whatever you're working on, I hope you're making progress. And if you feel stuck, everybody feels stuck at one point or another. If you feel stuck and you know it, please also know that you're not stuck. Like to be aware of it and feel stuck and like you've hit a plateau. Sometimes that happens to where it gives you a chance to catch your breath and reevaluate what you're doing before you make the next step. And if you're afraid, like if there's this voice in your head going, hey, don't do that, you're afraid, or hey, don't do this because of fear, then you can react to that a couple different ways. There's the outright thing of, am I really afraid? Should I do this? I mean, every time I spend money and invest into the market, it's like every time 500 bucks, 5,000 bucks. Am I sure I really want to do this? There's that. But if I'm outright afraid and can't explain it, maybe it's not a great move for me. Um, but there's also just this intrinsic self doubt. Like overconfidence is just as bad as underconfidence, in the sense of overconfidence makes you rush headlong into stuff sometimes without thinking, right? And underconfidence would be fear, and you can get dragged and plagued down by your own fears. So the plateau itself isn't necessarily a bad thing. The plateau is more of a breath catcher so you can evaluate what you need to do next. And once you determine a course of action, you need to move. And it'll be fearful and it might feel weird. It's like starting a brand new workout. Like it might not go well at first and you just got to stick with it. So if you're on the plateau and you've been running on the plateau for a while, I understand. Like I've been there, but I would encourage you to keep going and keep making progress. And that's the goal. Like everybody wants to make the splash. Like if you can automatically influence 1,000 people, like everybody wants that level of impact. But sometimes the better impact or really the more reach is in the ripple you make. Like if you just jumped in the pool, not really thinking about stuff, that ripple still hits the next edge. It might take it slower, it might take it longer to get there. right? It's not going to be that giant wave that crashes into somebody else, but the ripple will still get there. And sometimes we make a lot more progress. We see a lot more growth in the ripples of things. They just take a while to happen. So be confident in what you're doing. Be confident as you move forward. And that fear is going to nag you, and it will nag you as much as you let it. So sometimes fear is good. Like, are you really sure you want to jump off the cliff? Right? Sometimes fear is good, but sometimes fear is bad. Like, you have to jump off the cliff because this other thing is happening behind you. You have to jump off. Do I really want to jump off the cliff? No, but I have to because of this. Plateau's the same way, right? Be on the plateau as long as you need to, but don't also sandbag yourself into staying on the plateau and not climbing higher. So, whatever you have for the week, I hope it goes well. Stock market, personal life, anything else in between. Whatever you have for the week, I hope you make progress in what you're dealing with. And I hope your overall stock market investment goes well. I certainly hope mine does, but I hope these videos help. I make these videos for me because it helps me explain my strategy, but I want to tell people there's a better way. There's a much better way than single stocks. There's a much better way than single stocks and following the herd. So if you like the videos, by all means, drop me a comment, like it, share it, follow my channel, and I will see y'all on another video. So I wish y'all a great week and success in what you're doing. So bye-bye.